Today, we will talk about capital lease in accounting. A capital lease is a contract entitling a renter to the temporary use of an asset and has the economic characteristics of asset ownership for accounting purposes. The capital lease requires a renter to book assets and liabilities associated with the lease if the rental contract meets specific requirements. Even though a capital lease is technically a sort of rental agreement, GAAP accounting standards view it as a purchase of assets if certain criteria are met, which can have an impact on companies' financial statements. An operating lease is different in structure and accounting treatment from a capital lease. Historically, operating leases enabled American firms to keep billions of dollars of assets and liabilities from being recorded on their balance sheets, but this was changed when Accounting Standards Update 2016 to 2002 came into effect. A capital lease is an example of accrual accounting's inclusion of economic events, which requires a company to calculate the present value of an obligation on its financial statements. A capital lease is an example of accrual accounting's inclusion of economic events, which requires a company to calculate the present value of an obligation on its financial statements. For instance, if a company estimated the present value of its obligation under a capital lease to be $100,000, it then records a $100,000 debit entry to the corresponding fixed asset account and a $100,000 credit entry to the capital lease liability account on its balance sheet. Here are 3 key takeaways. 1. A capital lease is a contract entitling a renter to the temporary use of an asset. 2. Under a capital lease, the leased asset is treated for accounting purposes as if it were actually owned by the lessee and is recorded on the balance sheet as such. 3. An operating lease does not grant any ownership-like rights to the leased asset, and is treated differently in accounting terms. Hope this would help. Thanks for watching.